Chapter 1. Introduction. The need for education on business and investing has never been more important than it is today. Whether it is in real estate, stocks, or investing your life savings into a small business, positioning our money in an environment where it can grow is a necessity if wealth is to be attained. It is no secret that people who have aspirations to become wealthy consistently spend their money on assets that are likely to appreciate in value and produce a positive cash flow. On the other hand, many of those without a basic education in business or finance will often spend their hard-earned money on futile possessions that have little to no chance of ever producing income or having an appreciated resale value. I can't stress how important it is to do something positive with your hard-earned money instead of spending it on futile possessions, such as luxury cars or expensive clothing. It's not that you can't have these nice things. I'm only suggesting that you don't spend your hard-earned money to get them. Instead, spend your hard-earned money on an asset, such as a dividend-paying stock, which produces a positive cash flow that you can then spend however you please. Chapter 2. The importance of economics. How well a particular investment performs is generally influenced by the state of the economy. Before learning about a specific investment, it is essential to learn about the economy and the impact that it has on the world of investing. Also, it is very important to know what part of the economic cycle you are in and know how to adjust and react to each climate accordingly. The economy is measured by several economic indicators that take the temperature of the economy, and some indicators even give a forecast of what is expected of the economy in the future. Of all the economic indicators, some are more important than others. The most important economic indicator is considered by many as the parent indicator, and that is the gross domestic product, GDP. The GDP is the total dollar value of all goods and services produced by labor and property in the United States. It measures total consumer spending, private domestic investments, government spending, and net exports. A GDP that is increasing signifies an economic growth cycle that may cause inflation, and a GDP on the decline signifies an economy that is slowing down and may have the potential to cause deflation. Inflation is the rise of prices for goods and services. Deflation is the decrease in prices for goods and services. The GDP report measures quarterly activity and has a heavy influence on how people invest and spend their money. The report is released 3 times each quarter, being revised each time to finally come up with a final report for the quarter during the last month of the next quarter. For example, the final revision of the GDP report for the first quarter, January-March, would be released in June. The first estimate of a quarter is called the advance estimate, and it is released during the last week of the first month following the end of the quarter. The GDP figure is then revised during the following month and is considered a preliminary estimate. The second and final revision, which is released a month after the preliminary estimate, is called the final estimate. Keeping track of the GDP growth or decline numbers should give you a good feel for the state of the economy and also let you know what phase of the business or economic cycle you are currently in. There are generally 4 phases in the business cycle, which are described below. Business cycle. 1. Downturn. Starting from the peak in the economy, the downturn starts when the GDP has its first quarter of negative growth and lasts for as long as the GDP report is signifying negative growth. 2 consecutive quarters of negative GDP growth is officially considered a recession. During a downturn, investors generally get nervous and begin to dump quality investments for less than fair value. At this time, investment bargains are usually easy to find. 2. Trough. The trough signifies the end of the downturn or recession. It represents the lowest level in the business cycle. During a trough, because it is the lowest phase in the cycle, reports start to improve and the economy is getting ready to bounce back. In my opinion, this is the best time to invest, especially in real estate and stocks. Due to a lack of consumer and investor confidence at this point in the cycle, investments are usually relatively inexpensive, and I advise investors to buy as much quality real estate and stocks as possible. 3. Expansion. The recovery begins when GDP growth is positive again and continues until it reaches a new peak. A recovery technically becomes an expansion when the level of GDP surpasses the previous peak in GDP. Expansions are often accompanied by stock bull markets, which can make it very difficult to find good companies that are trading at fair valuations. 4. Peak. The peak is the highest point in the business cycle. In my opinion, this is the worst time to start investing. At the peak of a business cycle, the Federal Reserve will usually raise interest rates to slow down the economy or to prevent rapid inflation in home prices, and both the housing and stock markets usually lose steam when interest rates rise. Important economic indicators. Although there are many economic indicators viewed and adhered to by Wall Street, there are only 10 of them besides the GDP report that I find important, and they are listed below. It is important to understand that most economic indicators are subject to monthly revisions. Therefore, be aware that the GDP reading is not the only indicator that is subject to changes once more data is received by the source of the economic report. In addition to reading any particular economic report, it is a good idea to also read any analysis of the report, which can usually be found on CNBC.com and Bloomberg.com. This should help you become more familiar with the reports and to have an understanding of how to utilize them in your trading or investing efforts. 1. Consumer Price Index, CPI. The CPI measures the level of inflation or increase in prices for goods and services in the marketplace. When examining this report, it's good to look at the overall number and the core consumer price index, which excludes price increases for food and energy, which are considered pretty volatile. Inflation is generally high during times of an expansion and lower during a downturn. During an expansion, people and businesses are spending money at new levels, and the high demand for goods and services generally allows businesses to raise their prices. Generally, when inflation is growing too rapidly, the Federal Reserve, Federal Open Market Committee, will take action and raise interest rates, which will make money not as easy to borrow. The CPI report is released monthly, approximately 2 weeks after the month ends. 2. Employment Report. The Employment Report, which is officially titled The Employment Situation, contains information such as the unemployment rate, payrolls, and hourly wages. This report is very important as it is one of the first indicators each month of which direction the economy is going. In times of an expansion or growing economy, payrolls are usually up, and the unemployment rate is usually down, and vice versa for times of a downturn or a recession. As was the case during the Great Recession, when consumers are out of work, the economy suffers because of it. This report is also released monthly on the first Friday of every month. 3. Weekly Jobless Claims. The Weekly Jobless Claims Report, which officially is titled the Unemployment Insurance Weekly Claims Report, is released every Thursday and is closely followed by investors. This indicator reports the number of initial claims for unemployment insurance and the number of continuing claims for unemployment insurance. The weekly average is considered to be pretty volatile from week to week, and many investors focus their attention on the 4-week average for a more accurate picture of any underlying employment trends. The Weekly Jobless Claims Report is considered a leading economic indicator, which means claims tend to rise before a recession and tend to fall prior to a recovery. 4. Retail Sales. The Retail Sales Report, which officially is titled the Advance Monthly Sales for Retail and Food Services, measures sales of retail firms, such as car dealerships, clothing stores, gas stations, and grocery stores that sell to consumers. The Retail Sales Report is one of the most important reports as it gives us a good indication of consumer spending, which accounts for approximately 70% of the gross domestic product. Generally, when retail sales are strong, inflation shortly follows as it shows an increased demand for consumer goods. This report is usually released in the middle of every month. 5. Consumer Confidence. The Consumer Confidence Index, which is officially titled the Conference Board. Consumer Confidence Index gives a reflection of how consumers feel about the current and future state of the economy or business cycle. A decrease in consumer confidence usually causes a decrease in consumer spending and, therefore, a decrease in the GDP. When consumers are not comfortable about the current or future state of the economy, they usually tighten their belts and decrease their level of spending due to worries that hard times may be coming ahead. During an expansion, consumer confidence is generally high, as the job market is generally strong and many investments will have reached new highs. The Consumer Confidence Report is usually released the last week of every month. 6. Durable goods. Durable goods can be described as items with a life expectancy of at least 3 years. Durable goods would include washers, dryers, stoves, computers, and other long-lasting items. The report measures the level of shipments, inventories, and orders to manufacturers, not retailers. Durable good sales are generally up in an expanding economy and down in times of downturn and recession. This report is officially titled the Advance Report on Durable Goods Manufacturers' Shipments, Inventories and Orders and is also released monthly, approximately 3 weeks after the reporting month ends. 7. ISM Manufacturing. The health of the manufacturing sector is vitally important to the US economy since approximately 10% of the nation's workforce works in manufacturing. The report is officially titled the ISM Manufacturing Report on Business and is released on the first business day of the month. An index level over 50 indicates growth. Although its contribution to the economy has been on a steady decline over the last several decades, the manufacturing sector in 2012 made up approximately 12% of the nation's GDP and had the highest multiplier effect of any sector. For every $1 spent in manufacturing, almost another $1.50 was added to the economy. To complete the report, a survey is sent to 300 purchasing managers asking about the level of new orders, production, employment, supplier deliveries, and inventories. 8. Housing starts. The Housing Starts report details the number of single and multi-family homes being built. As we all know, when a home is built and then purchased, it calls for further spending on appliances, fixtures, and other household-related goods. This report gives us a pretty solid indication of where the economy is going approximately 3 to 6 months ahead of time. The Housing Starts report, which is officially titled New Residential Construction, is released monthly around the middle of the month and is heavily watched by Wall Street. 9. Existing home sales. The Existing Home Sales Report is released monthly by the National Association of Realtors toward the end of every month. This report measures the number of existing home sales that have been completed and closed. This report is a good source of information when looking to examine the health of the real estate market, as the president of the NAR and its chief economists will often outline the condition of the sector and mention any headwinds that it may be facing. 10. S&P Case-Shiller Home Price Index. The Case-Shiller Home Price Index is the last indicator that I will briefly discuss. It is also released monthly on the last Tuesday of the month, but it reports data from 2 months prior. The Case-Shiller Home Price Index measures the increase or decrease in residential home prices. It has both a 10-city index and a 20-city index, and it reports on metropolitan cities. This report probably, in my opinion, provides the best reading on the direction of home prices, which are important for real estate investors and for the overall economy, since rising home prices have a tendency to promote economic growth. Supply and demand. One of the most important yet simple aspects of economics is supply and demand. Generally, when the supply of something is high and the demand for it is low, the price for that item generally declines. When the supply of something is low and the demand for it is high, prices generally increase since there are more buyers than product available. This situation is very evident in today's society. For example, when the demand for gas or housing goes up, the price usually goes up with it, especially if the demand increases in comparison with supply. On the other hand, if the demand for something is low at Walmart or Target and the supply of that item is high, the item usually goes on clearance to entice shoppers to buy. This also is the case when department stores have clearance sales to get rid of old trends or fashions that are no longer demanding the attention of consumers. An example of this would be in the fall season, and summer clothes are marked down to their lowest prices. This is because the demand for summer clothes is very low in the fall, and therefore retailers need extremely low prices to entice consumers. The Federal Reserve. The Federal Reserve System, which was created by Congress in 1913, is the central bank for the United States. As the country's central bank, it acts as a bank for the government and for other banks. The Federal Reserve System is comprised of the Board of Governors, 12 regional Federal Reserve banks, and a number of branches that are supervised by the Board of Governors. The Federal Reserve Board of Governors has 7 members, who are appointed by the President and confirmed by the Senate. Board members serve terms of 14 years, which are staggered. Therefore, a member's term shall expire every even-numbered year. After serving a full term, board members may not be reappointed. However, if a board member is appointed and confirmed to finish the term of a resigning member, he or she may later be appointed to a full term. The chairman and vice chairman of the board serve 4-year terms and may be reappointed after their terms expire as long as they are still board members. The 2 most important duties of the Federal Reserve System are creating and implementing the nation's monetary policy and supervising and regulating banks. The most significant goals of monetary policy are to ensure both price stability and full employment. On the other end of the spectrum, setting reserve requirements which determine how much banks can lend is the most important duty in its role as bank supervisor. Federal Open Market Committee. The Federal Open Market Committee, which is a part of the Federal Reserve System, is responsible for setting monetary policy and consists of the 7-member Board of Governors, the President of the Federal Reserve Bank of New York, and 4 of the remaining 11 Reserve Bank presidents who serve on a rotating schedule. Therefore, there are 12 members on this committee at all times. The Board of Governors and the New York Reserve Bank President always serve on the Federal Open Market Committee. The 11 Reserve Bank presidents who rotate serve 1-year terms on the committee. It is important to note that all of the Reserve Bank presidents are allowed to attend committee meetings and participate in discussions. However, only 5 in any given year are allowed to vote. Committee membership changes at the first regularly scheduled meeting of the year. The Federal Open Market Committee holds 8 regularly scheduled meetings each year in Washington, D.C. During these meetings, there is generally a discussion on the state of the economy, and a vote is taken whether or not to change its target for the federal funds rate. Federal funds rate. Banks are required to maintain a certain level of funds or reserves that cannot be loaned out to borrowers. Such reserves can be kept in vault or with Federal Reserve banks. The Board of Governors, and not the Federal Open Market Committee, has sole control over setting reserve requirements. When a bank becomes in danger of not being in compliance with the required reserve amount, it can take a loan from the Federal Reserve or from another bank. The federal funds rate is the interest rate that banks charge each other for overnight loans. The actual rate at which banks charge each other is negotiated between the 2 banks, and the Federal Reserve has only limited control over this key rate. The Federal Open Market Committee also uses its ability to buy and sell government, and more recently, mortgage-backed securities to affect interest rates. When the Federal Open Market Committee wishes to slow down economic activity, it will take action to raise interest rates and decrease the nation's money supply. This, in turn, discourages banks from placing themselves in a position to need to borrow money and will cause them to loan out less to bank customers. When the Federal Open Market Committee wishes to stimulate economic activity, it will take action to lower interest rates and increase the nation's money supply. This, in turn, encourages banks to lend more, which leads to increased spending by consumers and businesses alike. Discount rate. The discount rate, which is ultimately controlled by the Board of Governors, is the interest rate that the Federal Reserve charges banks for short-term loans. Although not currently, the discount rate is usually set at approximately 1 percentage point above the federal funds rate. Since banks can procure loans from other banks at the federal funds rate, a loan from the Federal Reserve at the discount rate is basically a tool of last resort for banking institutions seeking to raise short-term capital. Key Federal Reserve reports. There are several Federal Reserve reports that are followed closely by investors and business leaders, and they are the Beige Book, FOMC meeting statement, and the FOMC meeting minutes. Beige Book. The Beige Book contains an up-to-date report on the economy that is collected by the 12 federal district banks, who collect information from business leaders in their respective regions. The information is compiled and distributed to members of the Federal Reserve and to the public 2 weeks prior to the next FOMC meeting. This information is then used to help shape debate for any action pertaining to monetary policy. FOMC Meeting Statement. The meeting statement is the actual decision of the FOMC on its target for the federal funds rate. The report is released shortly after the FOMC meeting and can often have an impact on the stock and bond markets. FOMC Meeting Minutes. The meeting minutes are notes from the actual discussion and debate that determined the direction of the federal funds rate. The meeting minutes provide great detail as to why the FOMC made its policy decision. This report is released 3 weeks after the FOMC meeting, so there are many investors who believe that this report is untimely and mostly ineffective as a tool for trading or investing. Last words. Having your finger on the pulse of the economy is critical if you are going to have long-term success with investing or if you plan on having a successful business operation. Generally, in times of a bad market or downturn, most businesses decrease their spending and tighten their belts as much as possible. As stated by Robert Kiyosaki, during times of a bad economy, I think that extra spending should be done on advertising and other marketing to give your business or product as much exposure as possible. When investing, it is unwise to buy real estate or stocks at inflated prices during the high points of an expansion or peak in the economy. But without the proper education, one can't possibly know what is considered a good or bad time in the economy. On the other hand, I recommend buying underpriced real estate and stocks during bad times and holding them until the market recovers. During the hard times in the economy, people are often scared and make decisions based on that emotion and sell very good investments for much less than they are worth. Likewise, when the economy is strong, people are more than willing to buy overinflated investments because they always think it can only get better, forgetting the last recession that took place only a few years earlier. It was Warren Buffett who said it best: "Be fearful when others are greedy, and greedy when others are fearful."